to 1,310, though they continue to maintain a neutral rating on Bharti Airtel given its premium valuation. But on Vodafone Idea, they've raised the target price to 13 rupees 10 paise, but they've also upgraded it from a sell to a neutral. Now, the key reason behind the target price increase for both Bharti Airtel and Vodafone Idea is the expectation of a tariff hike. According to UBS, it should come in Q1 of FY25, and they're building in a 10% tariff increase. One, elections will be out of the way, and plus a potential IPO from Jio incentivizes Reliance Jio also to go ahead for a tariff increase, and the others perhaps will also follow suit. On Vodafone Idea, the reason for the upgrade is, one, the stock has underperformed, and the recent announcements seem to suggest that the company is close to securing a sizable funding of 45,000 crore rupees, which could help accelerate its capex, narrow its network gap. But the bell has gone, and the Nifty has opened with a cut of about 89 points. So after 3 days of gains, the markets have opened the holiday shortened week with a cut of about 0.3%. Remember, Wall Street too took a bit of a breather, and the benchmark indices had opened with a cut. The big drag is coming in from the FMCG names. The Nifty FMCG index has opened in the red. Britannia is your top loser. That's down close to about 1.3%. Nestle, HUL weak in trade. HDFC Bank is nursing some losses. SBI Life is weak in trade. We're going to watch for HDFC Life, and yes, that's the top Nifty gainer after the breather, the relief that's come through on the surrender value. So it's not going to be as onerous as the market was fearing, and HDFC Life is the top Nifty gainer, 2% up on that. Adani Ports, after they've made that acquisition of nearly 1,300 crore rupees, Adani Ports is seeing some strength today. The mid-cap index opened in the red, but now is back in the green. All in all, it's a muted start in line with what the pre-open was suggesting. It's about 50 points down on the Nifty, cut of about 0.25%.
All right, Rima, a few stocks that are moving around. Mankind Pharma, the stock is down close to around 3%. Massive volumes out there. I think that large trade has taken place. So keep an eye out on that stock. It's down 3% because of that reason. Ashok Leyland, yesterday they've announced a 4.95 rupee dividend, and the record date they have fixed is 3rd of April. So explains why that stock as well is up close to around 1%. Now you'll be wondering that HDFC Life is the biggest gainer on the Nifty, while SBI Life is the biggest loser. The reason is that SBI Life gets least impacted because of these regulations, and also that could be now a bit of a switch. So you have SBI Life actually that's underperforming, while HDFC Life is outperforming. Yash tells me that in case those regulations did come about, revised regulations did come about, HDFC Life would be the one that gets the hardest hit. Now that's not come about, so actually HDFC Life is seeing some bit of relief in today's trading session. A couple of other big stocks that are moving around. Max Financial, it has valuation support as well. This no change in terms of regulations has come as a positive. So that's the big winner. And if you pull up a valuation parameter, you'll see it's trading at a sharp discount in comparison to its peers. So that's up close to 5.5%. ICICI Prudential as well up close to 3.5%. And Indus Stars, just take a look at the way that stock has moved. In the last 7 trading sessions, it's moved from around 230 to around 278. There is that wait for a large trade to take place, but in the meanwhile, the stock is flying away. And as we highlighted earlier today as well, JSPL, well, fundamentally things looking up for the steel sector because there is a correction in the raw material cost. The problem is steel prices are not moving up, but the promoter entity, that's Mr. Naveen Jindal, has joined the ruling party BJP, and he'll contest Lok Sabha elections. The stock normally gets a bit of a discount in comparison to its peers because of political uncertainty. Maybe that's a little behind them now, and that's why the stock is looking up 2.5% higher in today's session. Survi.
It's all about the broader market recovery. I mean, I think that's what started towards the end of last week, and that seems to be playing out even now. So if we talk about some more names, the movers and shakers, so to speak, watch out for Interglobe Aviation. After the analyst meet, some of the brokerages, Jefferies, for instance, they've upgraded their targets. Now they have I think a hold rating. Earlier they had a negative rating on the stock, and they've upgraded their EBITDA estimates by almost 12-13% as well. So Interglobe is holding out quite okay. The insurers, as Nigel also mentioned, Max is retaining that 6% gain. ICICI Prudential Life, 3.5% higher. So that's the other one to look out for. Vedanta, Nigel was telling us, I mean, that it's after 6 long years we'll see some resumption in Goa mining. But he also, told us a very important context that qualitatively it doesn't move the needle much, the kind of, iron ore you get in Goa. But anyway, for what it's worth, there's a little bit of green on that stock as well. Let's move beyond and see what else is moving in the broader markets, because that's where the churn seems to be. Avenue Supermarts, some of the brokerage upgrades that Mangalam was talking about, they're working well on the stock. 2% higher. Indus Towers is up 1.5%. Remember, Indus was a long call that Mitesh gave us on the technicals, saying that he sees a bit of a breakout. So that call is working well. Some of the other insurance players as well. New India Assurance is up and about. KPIT Tech is having a good early morning, 2% higher. Look at EIH, NBCC. There's Dr. Lal Path Labs, Jyoti CNC, the recent listing, 6.5%, 7% higher. So basically, the broader market seems to be alive and kicking. And the large cap screen, not bad actually. We've managed to recover quite well from the first initial cut. The Nifty is just about 30 odd points negative now. And watch out for some of the tech names. Look at HCL Tech. Smart intraday recovery from the opening lows. Even Wipro for that matter. Remember, that's the question that we were putting up as we started. Whether the whole reaction to Accenture, whether that was done and dusted in one day. Because the important caveat there is that Accenture did a guidance cut, but the year ends in August. And a lot of these companies are talking about recovery in the second half, which means, August and beyond. So maybe it's not really apple to oranges, just looking at the time horizon. So IT seems to be looking at some recovery as well.
And just one word on Mankind Pharma. I'm looking at a Nuvama Alternate and Quant Desk research report that's come about. They're saying post this 3% that's changed hands. The revised shareholding for the March quarter, that's reported by April 16th, which in all probability should happen. Then the stock automatically would qualify for the MSCI May 2024 review. So that's the reason why the stock has recovered a little bit from the low point of the day post that deal. The free float will increase, and that's what helps it get into the MSCI review as well. So that's a stock that I'm looking at. Another one that we're looking at is, IMFA, that's Indian Metals. They announced very, very late in the Friday's trading session that they'll be considering a special dividend in the next couple of years. Things that are working for them, well, they have got some part of that compensation from JSPL. So that's why they're going to be considering that special dividend. And ferrochrome prices have moved up. And as I told you earlier, for some of these users of coking coal, it's good news because coking coal costs are down by close to around 10% in the last 7 to around 8 sessions. So explains why some of these stocks are doing very, very well.
Well, IIFL Finance and JM Financial are also weak in trade. It straight away opened with a cut of about 2 to 3%. Remember, they're likely to face more RBI scrutiny. The central bank has floated an e-tender to seek interest from firms to conduct a special audit on JM Financial and IIFL Finance for the regulatory lapses, whether it was related to gold loan disbursement or the IPO financing. So I think on 12th of April is what the RBI has said, that the special audit will be conducted on these two firms. And there is that regulatory overhang as they face more scrutiny. And these are two stocks which are under pressure today. Yeah.
One more to add to the list, and it's an interesting one. PB Fintech. Now, stock's flat. It's not doing anything this morning. But remember that BMA Sugam has been launched along with this whole surrender value new norms. What is BMA Sugam? Basically, it's a giant, aggregator portal where you can buy insurance and, get serviced as well. So from the face of it, it looks like a bit of a competitor to the kind of business model that PB Fintech has going. And it's all about margins. And this being a wide UPI kind of platform, maybe there's going to be a bit of a margin crunch. We'll see how it plays out. But PB Fintech has done exceedingly well in the last 1 year. And for the time being, it's not showing any sort of a major negative reaction to the launch of this big portal from IRADAI. But let's move on and welcome our market master now on the show. Harish Krishnan is joining in. He's, of course, a senior fund manager equities at Kotak AMC. Harish, great to have you on the show. Let me ask you the most difficult question. Is the mid-cap, small-cap correction over? And I mean, just to expand on that, really, I think markets and investors, newer investors get really jittery, even with a 5-10% kind of a decline. But it was a bit of a scare. What do you think, are we past the worst, basically?
There has been a small correction for sure, but we've still come back to levels which were there in, say, December of 2023. So such has been the extent of the parabolic move that we've seen that, this correction, while welcome in terms of clearing away some of the froth, has just brought us back to the levels which were there in December of 23. I think from an overall sense, while we're positive on the economic construct, the fact that we've got counter-cyclical both on the monetary side as well as on the fiscal side. So therefore, you're seeing growth which is without steroids, which is very welcome. On the other hand, the only negative, if one may, could be that the sentiment is extremely exuberant even post this correction. So I think it's only about how do we marry the entry price to put in reasonably large sums of capital so that the underlying experience for our investors over the course of the next 3-5 years becomes a lot better. So while it is welcome, I think some of the froth has gone off. Of course, when the index corrects by about 10-12%, a lot more stocks fall anywhere between, say, 20-30%, and therefore it provides some opportunities for us to add on to some exposures across various sectors.
You are, in a way, betting on metals also, Harish. I was listening to some of your previous interactions, and metals is a sector which you've classified as a dark horse. Now, this is a bit of a contra trade. Not too many, the consensus opinion is not very bullish on metals. So can you take us through your view there?
So metals is clearly, as you rightly coined it, it's a dark horse trade. It's a contrarian trade. A lot of, is predicated on what China does, given the fact that it's the largest consumer and supplier of metals. So the sense that we have is twofold. One is that, obviously, given the extent of push that China is seeing, with respect to its economic construct, we do think that it's quite conceivable that we can see some kind of follow through from the government in terms of some policy easing. Now, whether it's going to be a big bang fixed asset investment creation, which was the case in the last decade, possibly not, but at least there's going to be some kind of a pushback. That is one conjecture. The second is that a lot of Indian companies have come in this cycle with very little debt. So unlike the previous cycles where the Indian companies also got hit by significant amount of debt that they were carrying, this time around there is limited debt on their balance sheets. The balance sheet health of most Indian metal companies are in fine fettle, and therefore it kind of limits the downside from a meaningful point of view. The third aspect is, from an ownership point of view, we do think that there is very little ownership in the space, and therefore that provides a reasonable sense of a better risk reward and a slightly higher margin of safety, and which is why we think from a medium term perspective we are wanting to take some exposure into the metal space.
All right. Hi, Harish. Good morning and good to see you. An interesting call out there. Under ownership and balance sheets in much better shape than what we have seen in the previous cycle. And that's one of the reasons why you're positive. Quick question, since we're talking about metals. Ferrous or non-ferrous, what do you prefer?
So ideally, it would be non-ferrous, given the significant extent of usage, across industries. We are going through this massive electrification drive across the world, and therefore, it genuinely does prefer the non-ferrous. But I guess, by and large, metals move as a homogeneous pack. It isn't that, there's too much of distinction from a price action point of view, but from a slightly longer term construct, we do prefer the non-ferrous over the ferrous names.
Got it. And, for the non-ferrous space, you also have the dollar play out there. A weaker dollar will be good news for LME prices, which could help them. So we got that. What about, I wanted to ask you, Harish, besides sectors and themes, there is some kind of cautiousness with regard to earnings growth, because we did see margin expansion, but top line growth wasn't that good. So part of the street is saying, hey, maybe bulk of this margin expansion is now behind us, and the top line growth doesn't look like it's going to come as much as anticipated. Do you think there's a risk to FY25 earnings, or do you think we'll be fine?
I think it's a reasonably fair construct. Now, we do think that, top line growth has been sluggish across sectors. So, while we can talk about headline numbers, I think what's more important for us is the breadth of the earnings across, say, the top 200 companies. And we've definitely seen a sluggish top line growth across multiple sectors, notably on the consumption side. I think investment as a theme is still doing quite well when we look at both from a top line construct. Obviously, over there, the bigger construct is that of the order inflow, and that definitely is seeming to do much better. But purely from a top line point of view, I think there's a greater pressure in terms of consumption. So, and that obviously feeds into multiple sectors and subsectors. So we are a bit sanguine on the fact that, that is one area which is kind of slowing down. Of course, whether it can see some kind of pullback, I think it's also a function that, especially in consumption, there's been a significant amount of margin increase that has happened across the board, especially on the FMCG pack. and therefore we do think that there is going to be some kind of price correction that needs to happen to excite back the customer. And therefore, we do think that without margin, without top line coming through, even margins are at risk for a lot of these companies. So the broader call out is clearly investment over consumption from our perspective, and within that, obviously, sectors which are more geared towards government and private capex, as well as on the real estate side, is what we think are in better shape at this point of time.
Harish, two PSU sectors where we've seen a parabolic up move have been one, defense, and the other one is railways, where we have seen greater spend by the government on defense and railways. The order wins have been exceedingly strong. But the question now is on valuations. And are they comfortable or uncomfortable, even if you have a longer term time horizon? Where do you stand on defense and railways?
I think we are a lot more circumspect on both of these. So if you look at, say, defense, and I'm just talking about index level, say NSE index on defense is trading on a price to book of close to about 10 times. It is even higher than the price to book of, say, the NSE consumption index. Now, these are very rarefied entry level multiples. So while there's a lot positive going on, including the export opportunity that Indian defense companies can cater to, as well as the indigenization drive that the government is focusing on, and obviously defense is a very topical point today, given the geopolitical scenario that's there. We think that the current valuations pretty much cap out any prospect of further medium-term value creation. So we are a bit circumspect on both of these within the broader PSU pack.
Okay. So Sanjay, overall, given the construct and sort of what we're in for, I think the next event now is obviously we get into earnings, and then finally the election event. For Q4, what are you expecting? Because Q3 we came off fairly okay. I mean, there weren't too many disappointments. So in the near term, next 3 to 4 months, as we get through this event season, how are you expecting the market to behave?
So near term is anyone's guess, and I guess we're no wiser than at least many others on the street. So what is it that we are looking forward to from assessing whether our medium-term thesis is right? Is primarily as rightly called out in the previous question as well, is in terms of whether there is volume growth coming back, especially on consumption side. That's a key yardstick that we are looking at across sectors as to where is the volume growth, because it's been a bit elusive. Obviously, there's been a significant inflationary push, from a pre-COVID to a post-COVID level, and to a certain extent that may have impacted volume. So volume growth is definitely a key area. If I look at other sectors, I think auto is something where we've seen a reasonable amount of persistence of demand, and especially as far as the passenger car vehicle and to a certain extent two-wheeler. What we are slightly more sanguine is on the agri side and on the CV side. So that's as far as the auto side is concerned. As far as investment, like I said, obviously government is a very big enabler and a catalyst, and is also a big spender on the investment side, and therefore it's very important to see the contours of the political formation that does come through over the course of the next 3-4 months. Obviously a similar government formation with a focus on investment is therefore welcome from a medium-term construct, because it does bring in that productivity benefits that can help catalyze the overall economic activity for a longer runway. So investment is something that we continue to keep a watchful eye on. Over there, we are more focused incrementally on private capex as to how that is shaping up. Just in terms of numbers, pre-COVID, this number used to be about 6 lakh crores for the listed companies. It has moved now to close to about 8 lakh crores. We think that there is still room for meaningful increase in terms of the private capex, and therefore we need a conducive enabling framework to persist, which will see us there. So that's something that we look out for. The third area is clearly that of the export basket. Now, this is something which is more driven by what's happening in the geopolitical landscape, as well as in the advanced economies from a perspective of whether they are going to see some kind of a slowdown. from a US market, we do see actually a stronger resilience and a pushback to the slowdown narrative. And to a certain extent, while that can kind of delay the rate cut theory, but I think a stronger nominal growth does actually benefit the export push through even in the near term. So export is an area of opportunity for us. We are positive on pharma and healthcare. We are looking out in terms of price stability in the generics basket, as well as in terms of API correction. So I think that's the area of opportunity for us. What we are watching out for is on the chemical side, where there's been a significant amount of pain in the last 2-3 years, and we are watchful of how the geopolitical landscape comes through, so as to take a slightly more constructive view over there. So it's across a whole range of sectors, but that's what we are looking out when we assess the next 3-4 months.
Got it, Harish. Appreciate you joining in and giving us your view on all those sectors that we discussed. Wishing you a good day ahead, and we look forward to having a chat with you rather soon. Well, let's focus though on the life insurance space, and Yash has been on top of that one. He's joining in to give us a quick revision of what the street was fearing with regard to regulations coming on the life insurers, and it's not come about. That's why we have few of these stocks that are celebrating. Yash, put into context.
Well, Nigel, the regulations that we're talking about are with respect to surrender value. What is surrender value? It's a price that is given to the policyholder in case of voluntary and early surrender of policies. Now, in December 2023, the regulator had come out with a proposal, which spoke about increasing the surrender value, and the increase was significant, about 2 times of what exists today. Of course, that put a significant pressure on all the life insurance companies. They were back and forth, and now finally, in terms of final regulations, what we have from the regulator is a watered version, a completely watered version of what had been proposed in December 2023. What the regulator has done is practically brought back the surrender value to the point as it exists today. So no increase in that sense across the parameters in terms of time parameters for surrender value. Now what this does is it removes the majority of the overhang from life insurance companies in terms of a potential increase in what they would have had to pay to their policyholders in case of surrenders, and reduces the margin pressure also which could have come about with this particular increase. Now what the regulator said is that they will have graded surrender value, which means as the policy matures, the value of surrender would increase, but large surrenders happen between the 1st and the 7th year, and in this particular period the surrender value which has been assigned by the regulator is largely same as it exists today. Now 30% is the surrender value in the 2nd year as proposed by the regulator, 35% in the 3rd year, 50% between the 4th and the 7th year, 90% in the last 2 years. Now just to give you the comparison between the numbers in terms of what was proposed in December 2023 and what has come about now, in the 2nd year what was proposed was a surrender value of 83,750 on a 1 lakh premium annually. What has come about is just 30,000. In the 3rd year, that surrender value proposed was 1.67 lakh. What has come about is just 70,000. In the 4th year, 2.51 lakh. What has come about is just about a lakh and a half. 5th year, 3.35 lakh was proposed. What has come about is 2 lakhs. So what this means is that in the first 7 years, the surrender value remains the same as it exists today, and large part of policies get surrendered between the 1st and the 7th year, which means no significant impact on life insurance companies with respect to negative margins on anything on those negative lines.
Absolutely, Yash, thank you very much. But I guess as someone who also tracks personal finance, for me the question really is that who's happier today, insurance companies or those who are insured? Maybe the regulators really try to strike a balance, which is what it's all about. Thank you very much for giving us the detailed contours of the final surrender value norms that have come through. To talk about this and get some more perspective, we have Tarun Chog, MD and CEO of Bajaj Allianz Life Insurance, joining in. We also have Gurmeet Chadha, Managing Partner and CIO at Complete Circle, with us. Thank you, gentlemen, so much for being with us. Mr. Chug, let me open with you, and that's really the thought, right? First, the market also took this very negatively, thinking that surrender values will be increased by a big notch. But clearly, that's not what the regulator has gone with. It's probably listened to the concerns coming in from the industry. Tell us the business impact, because the calculations show that for the first 3 years, the 3 years is absolutely no change at all, and a small increase in the value that you have to pay to the policy holders after 3 years, 4 to 7 years. So to what extent does it impact companies in general, and maybe you in particular?
Yeah, so I think it's good balanced approach, as you mentioned. The good thing is that both the customers and the companies have been taken care of in this. So the impact on company valuation should not be much. There will be a slight come down because a certain category of products will be slightly impacted. But having said that, see, what we have to understand is if you go to the background of all of this, life insurance is largely a long-term product. So the moment you try to do too much of surrender initially, when we did our math, first time I think this math was done for the sector, when we went to the IRDA, they also realized, and we were able to put it forward, that the biggest loser actually would have been the customer because the IRRs would come out. Usually, typically in these products, we invest up to 20-25% in equity plans, and that gives us the upside for customers. And now, given the fact the uncertainty on surrenders, which could, the surrenders could happen next year itself or almost the same year. So as a result, we would have to invest in cash, overnight cash, where the IRR, hence you can make out, would be significantly different. So I think the balanced approach came out well. The IRDA has nudged the sector to come up with a separate stream of products which have higher surrender values, and a little bit has been adjusted to increase surrender values in the existing products. So overall, for the sector, it's fine. And I think the growth of the sector would have been impacted significantly as well. That would be also maintained.
Do you have a rough number perhaps for the sector as a whole? Which is the year in which maximum number of policies actually get sort of truncated prematurely? Do people usually do that in year 2, year 3, or is it seen higher in the later years? Because now the regulation is very clear that if you stay with your policy, the longer you stay, the higher the surrender value in case you need to terminate it prematurely. So what's the current breakup, a rough percentage, if you have that, in terms of the year in which we're seeing maximum surrendering?
So usually it is the 6th year. It's the 6th year when dropouts happen. And I think what has to be understood, these things never get discussed, and good you asking us these questions. If I look at my own company, the average premium paying term of policies is around 7 to 8 years. So after 6th year, anyways, the surrender values, as you heard from Yash also, get a lot better the moment you're in the last couple of years. So that actually has very little impact on insurance customers.
All right.
Which is good.
Got it. Hi, Mr. Chugh. Good morning and good to see you in. And Gurmeet, thanks a lot for joining in as well. Mr. Chugh, I wanted to ask you, brokerages earlier, they were estimating anything between 400 to 500 basis point hit on the VNB margins for life insurers. That's if the earlier proposed surrender value had come into existence. Now, with these new regulations, that hit is entirely out, or could some hits still come about?
Yeah, the calculations were near apt. I think would have been even more, in fact, if you ask me. But with this change now, there is very little impact, and far, far lesser, if I might say. We are still doing the math. We are waiting the final master circular. See, some product streams will be impacted. For example, in non-par plans now, there will have to be an asset share as well, which was earlier. The concept of an asset share has come. It's a new concept. That will impact a certain stream of non-par plans, but largely very little impact now. You can always change the mix, right, over a period of time.
Okay, got it. All right, Mr. Chugh, we got that. Let's get in Gurmeet as well into the conversation. Hi, Gurmeet. Good morning and good to see you in. Well, Gurmeet, tell us, what do you all like from the insurance pack? Which are the top stocks that you like, and if you could give us some rationale as well out there.
Sure. So I think this the word threshold premium getting removed from the final draft is a bit of a relief to insurers with high non-par share, as Mr. Chugh also mentioned, because the threshold premium essentially said that above a certain threshold of premium, the surrender charges can only be applied to a certain threshold, and above that, the premium has to be returned, which, as you rightly said, could have impacted VNB by maybe 200 to 500 basis points. So that's why you see the guys with higher non-par, which is Max and HDFC Life, obviously showing more respite, at least in today's trade. I think Max has been doing very well. If you see 9 months of in terms of gross written premium, in terms of APE, I think they've done amongst the best. Also, one of their new product was Step, which is meant for the affluent segment, where you pay for just the terminal illness also, and there's an option of getting the premiums back. That's done very well for them. And they're both banca and proprietary models are doing well. Proprietary model actually grew 45-46% last quarter. And with Axis Bank infusing, almost 1,600 crores, I think eventually it will be Axis Life as things stand right now, improve the solvency ratio as well. So I think that's something we like. HDFC Life, has a little bit of a muted year post the tax, changes which happened in the budget. Also, Nigel, banks' focus has also slightly changed. Anyone with higher banca share is also getting impacted because banks are very, very geared up on deposit mobilization with the scenario you have. So I think we like Max. We also like SBI Life, which is more steady, and maybe HDFC Life in that pecking order.
Mr. Chugh, IRDAI has also said that no premium can be changed during the entire policy term of the contract. Earlier, it could be changed after 3 years. Will that be a bit of a negative or a hit to the industry?
See, let me just tell you more about this. In saving plans, usually this is a non-issue. It really is an impact in the critical illness plans and in the health plans. Health plans, anyways, we do not write indemnity plans. We write only benefit plans. So then it will finally, so that's not a big part of the entire piece. So where it then starts hitting us is really the CI plans, the critical illness plans. See, the problem there is the reinsurance for these will become a little bit more difficult. We'll have to find it. The market will have to adjust to a different level. So usually earlier, for every 3 years, we could have looked at the critical illness payouts, and the premiums could be revised accordingly. That is not possible anymore. So it will impact that. We'll have to see how we can take benefit of that for the customer. Good thing is we can now do short-term health plans as well and short-term critical illness plans as well. So that I think will make up for this. And we'll have to see whether long-term critical illness plans can be even manufactured.
Mr. Chugh, just to go back to that earlier point and also to, get a sense of the product modifications that you're speaking of, you said that the maximum drop-off happens in the 6th year. I guess that's also because of the way products have been designed, right? Because you're locked in for 5 years, you have to keep paying premium. And earlier it was also sort of, these were policies where the policy was being taken more from a, perhaps an investment perspective than pure insurance. And again, on that anyway, there's now a tax clampdown of 5 lakhs. So going forward, what are the product modifications that perhaps insurers will make? And will customers also have to be sort of educated that if you're a customer who perhaps wants to have flexibility of tendering in your insurance policy, before its term ends, then be ready to have a lower return product? Is that how things will evolve?
See, I think it is very difficult to predict. It's never easy to talk about what's going to happen, let's say a couple of years hence or next year, very clearly with the change of product guidelines. But what I can say is that a 5-year term usually is a pretty long-term term from an Indian mindset. If you were talking of Japan and other countries, they would usually sell 10-year, 12-year, 15-year products, and they'll be having very high persistency all throughout. In India, 5, given the way we work, given the way we think, we keep a lot of options open in front of our financial services plans that we've got. 5 years is long enough, and it's really the 6th year dropout, hence, will impact lesser. And as also I clarified that usually the 7th, 8th year is where most policies tend to get drawn out. What will happen is customers, with this regulation particularly, is that customers will have to be given more disclosures, which we're very happy with anyways. It will break down a lot of the mis-selling when it comes to long-term product selling. These disclosures, as you see in the regulations coming in, will result in people being more mindful of what they're getting. That itself will kind of bifurcate the market into 2 parts. One, somebody who's investing for the longer term, and one who's looking at maybe anytime surrender kind of product. So those kind of surrender products will also start coming. Initially, you're right. Those new category of products will not have a very high IRR that we can currently give when we have longer term products, because like I mentioned, the LM has to be matched. You would not be investing in equities in that. You'd have more cash, overnight cash in it. That itself will have to be seen. I have a feeling over a couple of years that will stabilize, and the IRRs on those products also will come in. Currently, people will test waters with that.
Okay. All right. We're in for interesting times for sure. That is from the policy buyer's perspective. But Gurmeet, last word with you from the investor's perspective. Which life insurance stock would you want to buy now? Now that at least this one overhang is out of the way.
So as I said, Surabhi, we have Max, SBI and HDFC Narivad. In fact, Bajaj Finserv, which is not really a pure insurance play, it's a play on other sectors, also gives a lot of valuation comfort. If you see the growth in EPS for last 2 years and price performance, I think it's been quite subdued. Also, I think there's something which I'm talking other than this news is this BMA Sugam, which is a marketplace for insurers. I think that will eventually lead to more transparency, more interest being catered for everybody in the value chain of insurance, including investors, intermediaries, and providers, and its impact on policy bazaar. I think that's something which the marketplace is something which is I want to see more other than the draft guidelines. Because PB Fintech has turned profitable. If you see even 9 months now, they are profitable. And it's a very asset-light model. And their credit business also now is picking up pace. So if you see their trail, which is what you make on mortgage on an ongoing basis now, contributes 15% to the overall credit revenue. So the trail is also picking up. It makes the annuity flows more stable. So that's something I'm tracking more other than this.
Gurmeet, great you brought that up. Actually, PB Fintech is doing very well right now, almost 4% higher. And I want to get Mr. Chug's comment on BMA Sugam as well. But just to complete the point, Gurmeet, so doesn't a new platform like this, where all insurers have to come through and it's been put together by the regulator itself, doesn't it offer some sort of higher competition to a platform like PB Fintech? Right now, the stock is showing no concern at all on margins, on commissions. But just your views on this.
So, I think you have to see, it's like ONDC versus Zomato and Swiggy, right? The platforms are always there, just that the market is huge and insurance is a technical product. Half of the terminology people don't understand. And PB Fintech has been working on even non-assisted sales. So one is the assisted sales you do, which is more digital. And then is a non-assisted sales. So insurance, in my view, is still a complex product. So I think it will take time. And that's why I said I want to look at this space more closely and see what the impact would be. So anybody who's asset light, who's been there for a time would obviously have a first mover advantage. And any marketplace eventually leads to more efficiency in the market. That's my personal view.
Fair point, and that's a very valid point that maybe it's still not that easy for people to go and buy policies on their own or DIY as they can do with mutual funds. Maybe that's a far more simpler product than insurance. Mr. Chug, your view on BMA Sugam and how that changes things with the industry, and just purely in terms of the channels through which you will be now selling, what changes with BMA Sugam also coming in terms of insurance and just the whole distribution framework now?
I think BMA Sugam is a significant step forward. And IRDA, I think, is really being very pragmatic at looking at the way customers would want to buy things in the future. A significant segment of the customers will find servicing, claim handling, the process of BMA Sugam to be very smooth and far smoother than what they currently see. More so, it will bring in a lot of transparency in the sector, and transparency is equal to trust. So the more the trust in the sector, it will only just have a multiplier effect on the market growing. And that's what is really my focus. That's what I think will make a big difference, because today people, when they lock in their money for 7-10 years, aren't really sure. So the moment they see it available on a large platform, which is everybody together, they can see it for themselves, it will increase the throughput of insurance. I think that's really where I focus on. In terms of distribution, it's all distributors will be present on this as well. So the process for them also becomes easier. So I think there are no losers, there are only winners in this.
Okay, gentlemen, thank you very much for joining in. It's been an enlightening discussion. Thank you for your thoughts. We'll get into a break. On the other side, we'll get you an exclusive market conversation with Ramdev Agarwal, Joint MD of Motilal Oswal Financial Services.
Welcome back. Well, the markets are still trading with a cut-off close around 50 to around 60 points, but volumes still on the lower side. Well, let's get you some exclusive market conversations now. My colleague Surbi caught up with Ramdev Agarwal, Joint MD of Motilal Oswal Financial Services, to talk about the market trajectory, how one should look at market corrections, and much more. Let's listen into excerpts of that conversation.
See, there is a thing called Anlom Vilom in yoga, isn't it? You keep breathing and then you have to breathe out also.
Yeah.
It is necessary. Yeah. If you don't breathe out, can you keep breathing up?
No.
You cannot. Markets are like that.
Yeah.
Every stock, every sector has to breathe up, and then after a big rally, you have to have a good correction. Sometimes corrections are immediately after small rally.
Sure.
Sometimes after big rally. But correction is extremely necessary, essential part of the stock market movement.
True.
You have to take it for granted. And that is why it is called risk asset. It can be up, it can be down. Sure. And that is what is not being liked by the investors at large. You have to understand it is integral. This is quotational losses. The corrections are quotational losses. They're not losses. They are quotational losses. You have been overpaid. 100 went to 200. You have been overpaid. Don't take it you are paid. You are still in the stock. You should have got only 160. So 200 has to come to 160. But it will not come to 160. It will come to 140. Because market doesn't have very precise way of giving a price. It is very approximate machine. It will go 5 steps up, 4 steps back, then again 7 steps up, then 4 steps down, like that.
So, recently, in the recent past, words like froth, etc., were being used for the broader market, mid and small cap. Do you believe that there's
of course it was
froth,
there.
and you believe more correction has to happen?
What is happening is, you must understand the factors driving the market right now. Factors are the number of investors which are coming in. After 75 years, first time we are saying celebration of retail investing or celebration of stock market. Okay, thanks to digital infrastructure, thanks to KYC norms being eased out, and generally the mandate by government that capital formation in the country is extremely important for the sustained growth in the future. Okay, now that equity, see, for a country to grow or enterprises to grow, job market to grow, you need enterprises to grow. Enterprises will grow only if you provide them adequate quantity of equity capital to start with at reasonable prices. And then debt capital is there. Once you have the equity, then you have the debt. But without equity, there is no debt. So the show doesn't happen. So clearly, this is happening. We are getting about 4 to 5 million customers every month. And this is a record. From 35-40 million in 2020, we have reached last month 150 million. I think we are headed straight to 300 million. 300 million, and then it's a revolution. And it is not going to happen overnight. It is going to take 3 to 4 years. And then after that, after 300 million, let's first reach 300 million. Then we'll talk about 600 million. Okay. Now what is happening is the pace is accelerating. Instead of going down after 4, 5, 4 and then 3.5 and 3, it is actually going from 3 to 4 to 5. And now, let's see, we have done 4.65 max. I don't know what is the number for March. But my sense is now, initially there were only 30-40 million customers satisfied. So they were bringing their brothers and sisters and all. Now 150 millions are satisfied. So the whole society after society is coming in. Like the whole city is coming. Whole township is coming. Whole building is coming. So now there is a lot more movement and acceptability of the concept of investing some portion of your savings. See, last year, in 23-24, as of this Friday, the number came. We have collected about 17 lakh crores of fixed deposits. Bank deposits have grown by, I think, 13% and 103. So I think 17-18 lakh crores have come. I think stock market must have got during the same period about 3 to 4 lakh crores, maybe 5 lakh crores. So only 1/4 or 1/3 of the fixed deposit. That is not the right thing. Eventually, it will become almost equal. But that may take 5-7 years. So it is we are into midst of very huge market, what I would say, savings allocation change in the economy. And this will happen, it will take time. And economy has to also perform. See, just by bringing money, the show is not going to happen.
Exactly. People are coming because at the end of the day, they have seen what has happened from March 2020. And a lot of the retail investors, there are a lot of new time people who've come to, new age investors who've come to the market, right? They've not seen cycles, they've not seen a meaningful correction. Does that bother you at all?
No, it doesn't bother me because the color money is same. Whether you put it as a professional or some new guy puts it. The issue is that overall aggregate money, where it is going. Is it going into the building of the infrastructure? Is it going to build a corpus? I mean, is it a primary issuance or is it a secondary? Like ITC BAT taking away, say, $3 billion or $2.5 billion.
Yeah.
That doesn't help that much. Or Indigo promoter taking away $1 billion, that doesn't help. Of course, it is necessary part of the capital market, but disproportionate amount should go into the primary issuance. So like a telecom company issuing, say, 50,000 crores worth of bonds or equity, and that being subscribed. What they will do, they will go and put up new towers, that will actually spur the economy.
You know, it's really interesting that you brought up some of these huge block deals that have happened, and a lot of them have happened. I think 2023, we saw massive blocks coming in. It's continuing in 24. And this is also a question that comes up because at the end of the day, because of the retail revolution, a lot of the buyers are mutual funds. So, I mean, I am buying at the end of the day when maybe a promoter is selling or maybe a very sophisticated
That's fine. They also have a right to sell.
They have a right to sell, absolutely. But is there any reason to worry because they are supposedly smart
there
insiders?
There is nothing to worry. There is natural
selling?
market phenomenon.
Okay.
Surabhi, you must understand. If you raise the prices, supply will come. Asman se supply aayega. Whether FIs sell, promoters sell, block deal happens, new issuance come, supply will come. So first 3 years, we saw the boom in the demand side because of this inflow. Now you see the power of supply.
But does that mean that maybe for an entrant, there's a bit of a top in the market?
Yeah, don't become too topish, this, that.
Achha.
It's a part of the game. See, if you're playing football, I mean, if one guy is Manchester United, other side is Motilal Oswal team, what will happen? They'll just go and keep hitting. Why? There has to be supply. Supply will come, and that is the healthiest part. Okay. That's the real role of the stock market.
Okay, so Mr. Ramdev Agarwal not at all worried about the rise in promoter selling, all the block trades. He's saying it's a deeper market, it's a healthy market. The correction has made it even healthier. And for medium to long-term investors, there's absolutely no reason to worry. We'll play out more excerpts from that interview. Nigel, he's expecting the Nifty to double in the next 5 years. So there's a man who's saying invest for the future.
Indeed. All right, interesting conversation. We'll keep getting you various parts of that conversation all through the day. But let's go to our special segment now, Charting Trends. Mitesh Thakkar joins us to help us out with a few ideas. Hi, Mitesh. Welcome back on the show. Well, let's talk about a couple of ideas that you have. Pidilite, that's the stock that you're looking at and it's looking particularly good on the charts. Tell us more.
Nigel, I think, very importantly, what Pidilite was doing since about May, June of 22 was getting into a contracting pattern on the monthly basis, which means that the longer term charts were contracting. Actually, I saw that for the last about 18 months, the stock didn't give any kind of absolute returns. The indicators were coming, coming out from the overbought levels and settling down on the monthly basis. So we saw the stock, just being sideways broadly, not getting past 2,800 and not falling much below 2,400 on the downside. That contraction has now come to an end and there's some kind of a breakout which has taken place. Recommend buying this one for targets of 3,400, 3,600. I think, looks very logical extension and even possibility of 3,900 exists on the chart. So these are the upside, this is the kind of upside which this stock price can give in the next 4 to 6 to 7 months. And unless the stock starts breaking out below 2,740, the long-term trend and the bias will be on the upside. So that's a very strong buy for me for the aforementioned price targets.
And the target price over the next few months is 3,900, right?
Yeah, that's right.
Okay, over the next 5 to 7 months. Let's move on to the other one, Gujarat Gas. What's the chart telling you?
This is a stock, which had a very strong month in January 2024. And then what we have seen is that for the entire month of February and March, the stock is giving a pullback. Now, given the fact that this is a pullback happening on the longer term charts, it gives you a very enticing entry point in terms of risk reward equation. So accumulate the stock between 530, 500 range and keep a stop below 455. So you have about 10% kind of a risk. And the long-term chart suggests targets of around 620, possibly 670 in the next 4 to 6 months. So giving you a good risk reward equation from the current levels. And since the long-term trend is on the upside, very clearly a buy for me.
All right. Mitesh, I particularly want to know what you're going to say on HUL. You know, that stock goes into its shell for a while, for a few years sometimes, and then it comes up and then it moves. You know, as we saw, I think between 2000 to 2010 didn't move at all. 2010 to 2020 went like a rocket. And last few years, big underperformer. What's the view right now?
In fact, I think, in the near term, which is a few months for the stock price on the long-term charts, Nigel, if you observe the movement starting from September of 21, I think on about 8 or 9 occasions, the stock has touched levels of 2670 on an intra-month basis, never giving a monthly closing above that. So it's, some kind of a top formation which has happened over here. And now there is a breakdown below the monthly averages. So my sense is that the stock is an underperformer. Avoid if somebody has it, it's an exit. I'm looking at sub 2000 levels as the minimum. We could see, in panic, I think even levels of around 1940 to about 1875. But I think this is not a stock which will participate in the upside. So if you have your money blocked over there, exit and I think, try to look for better opportunities.
And finally, SRF.
With a disclaimer here that I've just bought SRF into my portfolio as well. I think, again, this is a stock, which was consolidating in the range of about 2200 to about 2600. That consolidation has already lasted 24 months and now there are early signs of a breakout. So, I have bought some quantity. I would want to see the stock price get beyond this 2625, 2630 levels to add more. But I think once that happens, people stop at 2480 and the measuring implications of this breakout suggest that on the longer term charts, we could see the stock head towards 3250 as a minimum with 3450, 3500 as the logical targets.
Okay, gentlemen, Mitesh, thank you very much for joining in. Those are some medium-term, stock opinions. Pidilite, HUL, Gujarat Gas, and the last one is SRF, which Mitesh likes over the medium term, over the next couple of months. The Nifty is still down close to about 70, 80 points, 76 points lower. The Sensex is down close to about 300 points. Mid-caps, though, are holding up. On the way down, Reliance Industries is down close to about 1%. So that's hurting on the sidelines. That's a heavyweight, which is weak in trade. Power Grid is the top Nifty loser. A couple of pharma names like Divi's Laboratory, Dr. Reddy's, Cipla are weak in trade. In fact, even the Nifty Pharma Index is one of the big drags today. Tata Consumer, Maruti. Maruti is under pressure because remember the company has recalled 16,000 units of Wagoner, I think, and Baleno also. So that recall is a bit of a sentiment negative for Maruti Suzuki. We'll slip into a break. On the other side, Manisha will join in with the latest from the commodity space. Welcome back. As promised, let's talk commodities. Manisha is with us. Manisha.
Well, thank you so much for that. I'm looking at metals as a sector because there's some cooling off here after that recent run-up that we saw in prices. Well, the dollar is strengthened a bit, that's weighing on. And in the recent days, while of course we've seen recovering data from China, the expectation that the US Fed rate cut will happen in the month of June, there is a 75% probability of that. And the markets also have seen better Chinese data coming in. But from those kind of levels, now there is some profit taking. We're closing towards March ending as well. And this could be one of the reasons that this is happening. I want to start with copper first, and that one is off the one-year highs that we saw it trading within. We saw 9,100. It's trading at $8,700 a ton now. The prices have had run up because China smelters cut production, halted production for various areas there. And also when you look at the deliverable copper on exchanges, that is gained up by 20% on a week-on-week basis. But after that hype and all-time highs in China, there is profit taking by speculators, hedge funds as well that you have seen come in case of copper. Zinc as well has seen a very sharp decline in the matter of last 2 or 3 trading sessions. That is after Glencore announced that Nordenham smelter will resume after 1 year. Also, when you look at the zinc inventories on LME, they are at a multi-year highs, almost standing at around 275,000 tons there. Not just copper and zinc, nickel is off its 1-month highs as well. We are trading at 1-month lows actually when it comes to this one. This is after Indonesia has announced that the production quota of 152,000 million tons is what they have approved and is in process of approving by the time March ends. So you have more nickel coming out of Indonesia, and a similar story coming in for tin as well, which is off its 8-month highs. 1, the inventories have been increasing, and 2, you have Indonesia issuing new production quota of 400,000 tons for this year. So all the metals after that recent run up have come under some profit taking. When you look at the prices on a week-on-week basis, we are actually trading into negative for many of those there. For this week now, it's going to be about the China manufacturing and services PMI numbers, and it also is going to be about the Fed speeches and inflation data. All of that comes in this week now. I want to take you through on what the metals have done for the month of March until now, and that's a story to tell, because when you look at the non-ferrous space, we are in the positive here. Copper is up 4.5%, and the best of the gains clearly coming in for aluminum there. Steel and iron ore prices are up on a week-on-week basis, but on a month-on-month basis, we still are into negative here, but clearly that has improved also. But the best gains clearly are in for the precious metal prices, where you have gold up 7.5% and silver is an outperformer with 10% gains for the month of March.
Okay, all right. Thanks a lot for that, Manisha. Well, let's focus on a couple of stocks that are moving around. IMFA, that's Indian Metals, ferroalloys. Well, that stock is buzzing in today's trading session. It's up close to around 6% and moving on massive volumes. Let's tell you why. In the next couple of days, that's on March 29th, they're going to be considering a special dividend for FY24. The street is quite excited about that. Why could they be considering this special dividend? Because they've received around 130 crores with regard to compensation for the Utkal C coal block, and they have another 200 to 250 crores that's due. So the entire sum was around 350 to 380 crores odd. They're expecting to get that. For the time being, they've got around 130 crores, so they want to reward their shareholders. And point number 3 is the margin outlook could be better, because I'm looking at global pricing for ferrochrome. Well, it's been benchmarked higher, which means that visibility for Q1 FY25 margins are good. And also you have coking coal costs that have come down. For IMFA, their biggest strength is they're getting ferrochrome ore, chrome ore from their own backyard. And because they're getting the key raw material from their own backyard while the globe is in scarcity, well, that's what's helping them. So they're going to get the benefit of higher selling price of ferrochrome, and they are also going to get the chrome ore prices, which will not move from their own backyard. Put all that together, the stock is moving, and it's moving higher on much higher volumes than we normally see. So that's about Indian Metals and ferroalloys. But let's talk about Avenue Supermarts as well. Manglam joins us to tell us more about that. Manglam.
Well, there was an upgrade coming in this morning from ICICI Securities. They've upgraded the stock from hold to add with the target price increase from 4,100 to 4,800 as well. And they've compared it to the likes of Nestle, where they say that they expect DMart to actually go ahead and outperform Nestle in the medium term. Why is that? Well, because over the last 2 years or so, DMart's premium over Nestle has reduced from erstwhile 50% to about 8% when it comes to valuations. And the problems that DMart has are largely in the price and known. So there is limited downside risk as well. And even if you compare the revenue CAGR that DMart has posted, which is lower than the pre-COVID levels of 25 to 30% to around 18 to 21% with 6 to 10% same-store sales growth, it is much higher than the other comparable FMCG peers. And as a result of which, they believe that it is a stock poised to outperform from here, especially given its healthy net profit margin. What about Nestle that they do not like in the very near future? They say that the positives have played out for Nestle and they expect time correction in the stock price. And the revenue growth outperformance that Nestle had versus peers over the last 8-10 quarters is also likely to moderate because now price hikes are in the base as well. So if they had to make a portfolio choice, they would choose Avenue Supermarts over Nestle, and that explains the up move that we're seeing on DMart right now.
Okay, thank you very much for that. We'll get into a break. On the other side, we'll put the spotlight on RBI's actions on the financiers, with the recent one coming in on IIFL Finance and JM Financial, as RBI plans to conduct special audits. They've floated e-tenders for the same. We'll be joined by Abhisar Divanji of EY India and Sanjay Doshi of KPMG India on the other side.
Welcome back. Well, let's put the focus now on the recent RBI actions on financiers, with the latest coming in on both IIFL Finance as well as JM Financial Products. Now, the RBI has asked for special audits to be conducted on these two entities. And remember, this flows from the earlier move when the Reserve Bank of India had stopped IIFL Finance from taking any further sort of steps in its gold loan business. Basically, that was shut down with the immediate effect. And ditto for JM Financial Products, loan against share business. We've got two experts of the BFSI space to give us some more perspective on this heightened scrutiny that we're seeing from the regulator. Sanjay Doshi, Partner Financial Services Advisory Leader at KPMG India, is joining in. And we'll also have another guest in just a bit on this. Sanjay, thanks so much for being with us on this discussion. What do you make of things? Because in the recent times, we've seen the RBI get extremely active with respect to individual corporates, individual BFSI players. It started with Paytm, then IIFL Finance, JM Financial Products. And now what we're hearing is that there will be a special audit in some of these cases. How would you read the news of this special audit?
So, see, effectively, RBI definitely is very worried and taking proactive steps, especially in some of the lending areas, lending where there are a lot of retail loans. Personal loans is one of the big areas, and you've seen actions or regulations really coming up in those areas. And also areas where they feel that there can be potential evergreening, or the collaterals and the process around verifying the collaterals or the KYC is not done properly. And especially in gold loans, how the quality of the gold has been measured by NBFCs or banks. and also the way the auction processes gets conducted. So it's more effectively really getting ensured that the processes are there in place, steps taken proactively, so no systemic risk really comes in the future.
So got that. They're looking to check for evergreening, if there is any systemic risk. Is this going to be a forensic audit, Sanjay?
I would call it a special audit yet. In terms of forensic means, okay, fine, there is an objective where you can see frauds really happening. So whether you can call it a forensic investigation, too early. It's more of a special audit where RBI is taking an independent audit to really understand the processes behind it.
And how long would an exercise of this nature take to complete?
Well, it really depends upon how deep they really want to go to. It can take anything around 4 to 8 weeks, depending upon how deep they really want to go to and the kind of period, the scope really they want to cover.
So, Sanjay, what in the past, what do we know, and what can be the typical outcome? Could it just be, more from an observation standpoint, or could, special audits like these lead to, fresh curbs, more regulation? What does history tell us?
Well, you will see this kind of audits definitely something of the recent where RBI really is going, as I said, proactive. So yeah, one of the options or one of the outcomes can actually be changing in processes or more tightening of processes coming in. I think RBI has really laid down guidelines. One is to really ensure that, that particular audit which is happening on any company, that company is really following that process, the guidelines, etc. But in top, if they really find lacunas really happening where it's a market practice and that market practice needs to be curtailed, then definitely we'll see more regulations coming in.
You said that, while it's difficult to ascertain the total time duration of this exercise, but it may take 4 or 8 weeks. So it's safe to assume that at least for 2 months now, both IIFL Finance and JM Financial may not be able to resume the practices which RBI has clamped down on, right?
Well, that's something I don't know. I can't comment on what's really going to happen and what will be the action there from the company's perspective.
Okay. You said, the possibility that this may be a market practice also, right? The RBI wants to assess if this is a very company-specific issue or is this a market-wide practice that they want to bring under control. Have you done any early analysis on this particular point?
I don't personally have visibility whether they have done early analysis. Of course, there have been actions in the past. They get data. RBI today gets a lot of data, right? They get access to the portfolio data. They access to in terms of the audit reports which the companies have, the internal audit reports, etc. So there can be some signs, but see, effectively think about gold loans, right? Gold loans where the purity of gold is definitely very important. And whether you really are seeing the practices around auctions, are the auctions really happening at a very low value? Are the auction processes really conducted where the borrowers at the end of the day is a defaulter, right? But there should not be any kind of unfair practices really happening there. So gold loans definitely is one area where RBI just wants to ensure that things are clean. The borrowers also get a fair, hearing on what's really happening on those collateral and on the auction. And at the same time, there should not be any over leverage or evergreening or lending against collateral. So for example, is the purity at 18 carat, but is it considered at 24 carat? And hence you really are actually giving it a very high loan to value. So some of those practices will definitely be under the radar.
Okay. So, that's on the gold loan side. The other issue which pertains to, of course, the other entity, which is JM Financial Products. I mean, that do you think is more a company-specific issue perhaps, or when it comes to this model as well, loan against shares, whether this also calls for wider scrutiny looking at overall industry practices?
So it's also happened in the past, right? Means if you actually see post or during the Lehman crisis also, you actually see a lot of leverage finance happening on IPOs, happening on even buying shares, etc. And that point in time also, a lot of companies and a lot of NBFCs have taken losses. So today, whether it's a market practice, whether it's a per se company issue, definitely IPOs are on the upswing. A lot of financing happening behind the IPOs or for the IPOs. So is there any kind of wrong practices really happening there? This will be definitely a case where we'll figure out based on the audit. Can't say whether it's per se a company or per se a market.
Sure, yeah, I think absolutely we do have to wait for the outcome and see what more the Reserve Bank has to say. Abhizar Jivanji, partner and national leader of financial services at EY, is also joining into the conversation. Abhizar, great to have you on. So, we've been asking Sanjay whether the street or investors or stakeholders need to be a little more concerned now that there is this special audit that the RBI has called for on these two entities? How should we interpret this new development?
So again, I think it's the next logical step because RBI has actually asked them to stop the operations. And the next logical step would be to get in and appoint an external person to do an audit. What is to be interpreted out of this is I think RBI is increasingly getting more and more exemplary. So I think it's about the product and the process and less about those companies. Because I think these practices may be followed across, and that's why these companies would also be following them. But the idea is that when there is an audit done on some of these companies, then others tend to get more cautious about what they need to do. Everyone, in fact, is introspecting. Whenever I speak to other NBFCs, they're actually looking into their portfolios and figuring out what they could do better and what is not in the spirit of what RBI wants them to do. So I think RBI is coming down. But as I've always said, in one of your earlier talks too, that the larger issue is the way credit is flowing and where we are not really sure of the end use of credit. So you do gold loans, one doesn't know where the money is going. You do capital market loans, you don't know where the money is going. At the end of it, if it's a machinery loan, then one knows that one's buying a machinery or a productive asset or even sometimes consumer assets. But when you do PLs or when you do secure lending against gold shares, one really doesn't know where the money is going. And I think that is causing a larger systemic risk to the RBI.
On Abhisar, on the capital market standpoint, gold, you can still argue there's a collateral, and of course it's the purity and the value of that collateral that in this one case is what the RBI was trying to sort of check upon. But on the capital market side, are you expecting any further regulations, maybe more sort of checks and balances, more curbs, perhaps in the coming days?
There'll be a combination of RBI and SEBI. So RBI's concern is more on systemic risk and less on markets. SEBI would be more concerned on market manipulations. Is money being given to individuals to subscribe for shares, which is then dumped into the market on listing? So those kind of issues and whether issues are being artificially made to succeed, those kind of issues is where SEBI will have a concern. So I think it's going to be joint regulatory action to some extent to figure out where the end use of the money is going and are investors being duped in the bargain? Because it's unfortunate in our country we either have the fixed deposit markets of the banks, or we have the equity markets to gain money, and as investors seek more and more yields given expected inflationary trends, people are tending more towards the equity markets, not really knowing the kind of risks they're taking.
All right, gentlemen, I think we'll perhaps wait by, and the coming days are going to, give us some more cues and clues to figure out what's happening with the lending on the NBFC side. Thank you for joining in to both of you. And with that, we are out of time and at the end of Bazaar. Leaving the market with about a 70-point cut on the large cap space. It's the mid cap and the broader market that's faring a little better, at least at the index level. Thank you very much for being with us, but do stay tuned. All the action continues. Up next is Chartbusters.
CNBC-TV18 News Break confirmed life insurance companies surge after the insurance regulator IRDAI approves graded surrender value rules, which imply largely unchanged or lower rates for policies surrendered up to 3 years.
Mankind dips nearly 3% after 1.3 crore shares worth around 2,750 crore rupees change hands. Page Limited, an affiliate of private equity firm Chris Capital, is likely to be the seller. The stock has come off the low point of the day.
Interglobe Aviation surges after brokerage firm UBS increases the target price from 3,900 rupees to 4,000 rupees a share, citing strong growth prospects in the aviation industry. The stock hits a fresh high today.
Avenue Supermarts climbs nearly 5% after brokerage ICICI Securities upgrades the stock from hold to add, raises the target price to 4,800 rupees from around 4,100 rupees, citing the possibility of growth outpacing